What is up, you up to? Today we're talking about mutual funds, and we're also going to be talking about the comparison between mutual funds and index funds and show the difference between the two, but also talk about what mutual funds have to offer that index funds don't have to offer, and also the risk between the two. So with that being said, I hope you enjoyed today's video. Let's get right into it. But before we get into the video, please hit that like button and the subscribe button. It would really help me out. We're on the path to 10,000 subscribers. So I hope you join the journey and you catch the videos here in the future. So what is a mutual fund? Well, a mutual fund is a combination of different stocks. It can be in a broadband mutual fund, so it has many different categories, more resembling of what like an index fund is, to where you can have many different sectors in one fund. So if you haven't seen my previous video about index funds and you're confused at all, I'll go ahead and link that in the description. Go watch that video before watching this video, because I'm going to be referencing that video a whole bunch. So make sure you're there and you're caught up, and then come back to this video and you'll be able to be all touch to base. So mutual funds really are just index funds, but index funds, as stated in the previous video, it has about a 7% return with whatever interest is on top of that. So it's about 11% usually. But mutual funds, they don't have a set stock. So index funds, they have to go through a filing process to change what stocks is in them. But mutual funds, they have full reign of just dropping a stock and adding a stock whenever they want to. And the goal of a mutual fund is to outperform the market. It's to provide the buyer of the mutual fund some sort of monetary benefit to get into it. But also mutual funds offer great diversification, because there are some mutual funds that are focused on single things and single assets. So for example, there's a bunch of mutual funds that are solely based on dividends. So there's people that do dividend investing, and their whole portfolio is just making dividends. Yes, the stock can go up or down, but they just want that percent return on how much they invested. And so some mutual funds that are dividend based, they have a set guaranteed dividend amount. So for example, we're going to be looking at a couple different stocks, and I'm going to go through each of them and what they have to offer and what you can gain from them. So for example, we're going to be talking about the Vanguard High Dividend Yield Index Fund. And this is a great way to be diversified across many different sectors. So there's technologies, finance, and many other things all into one fund, very much like an index fund. However, this mutual fund that is offered by Vanguard is very much focused on a slower growth of the stock by itself, but a very high yielding return in dividends. So the growth of the mutual fund is usually positive, so you're still making money on it, but you're making more money back on dividends. And what's really cool about this is this mutual fund is made up of a bunch of big corporations that offer really high dividends. For example, Johnson & Johnson, which is 3.3% of the portfolio, Procter & Gamble, which is 2.7%, Exxon, 2.5%, JP Morgan and Chase, which is 2.5%, Home Depot, 2.2%, Chevron, 2.1%, Pfizer, 1.9%, Bank of America, 1.8%, and Coca-Cola, 1.8%. So these are all very diversified. You got healthcare, you got finance, you got industry, you got home improvement. So you're covered by a bunch of different sectors that all pay massive dividends. And that's why the stock is so good, is because it focuses and it diversifies your money. So you buy one share for $105. I think that's what it's at. I'll make sure to put it up here so you can follow it, or you can see the current price. So you pay for that one share and you have growth in the stocks by themselves, because look, J&J, JP Morgan, Home Depot, Pfizer, Bank of America, Coca-Cola, and Exxon are all companies that have the great potential to grow. Exxon's moving to green energy. Bank of America is just a really consistent financial entity in the US and probably across the globe. Coca-Cola is a global company that is great at returns and it has a very high dividend. Johnson & Johnson is a massive healthcare conglomerate where they just make everything and anything you can think of. And Home Depot is just where everyone goes to get their stuff to improve their house, and a lot of contractors use. So these are all companies that are extremely reputable and have very stable incomes. No matter if the market is up or down, they have very consistent returns. That's why their dividends are so high, but that's also why you can see returns on the growth of the mutual fund by itself as well. So this mutual fund, yes, it's focused on outperforming the market, not by the growth of the mutual fund, but by the dividend that is returned to the customer. And that's why mutual funds are different from index funds. Index funds, they just look to buy a bunch of stock to where the stock will will perform with the market, but mutual funds are looking to outperform the market to put more money in the pockets of the investor. And so that's why a lot of people, when they have Roth IRA, they mix and match. They buy a lot of index funds because it has a very stable market mirrorship. But at the same time, mutual funds can also bring you more money by dividends or by investing in hot commodities and stuff like that. So that's why Roth IRAs are mainly made up of mutual funds and index funds. It's because those are two of very high yielding, consistent return funds. And so that's why I recommend mutual funds and index funds if you're looking at getting into a Roth IRA or a 401k and just setting up a retirement account, because all those gains, especially if it's a Roth IRA, are non-taxable. So that's why I really enjoy investing in mutual funds and index funds. They're long-term investments, but they can have very consistent and high returns. Usually with index funds, you see less high returns. You see that consistent 7%, but then with mutual funds, you can see a higher percentage. So while you're saving up for retirement, you can really just put, what I'm planning on doing is putting a majority, like 7%, 75% of retirement into mutual funds and then 25% into index funds. And that way I can have higher growth. Or I may even split it 50-50. I'm not sure yet. I got to think about it and see what my planning is right now. But my current portfolio is 75-25 and 75% in mutual funds because they have higher yielding and they outperform the market. But then at the same time, if the market takes a hit, usually mutual funds take a bigger hit. But then at the same time, mutual funds can recover quicker because they're allowed to trade commodities and put one company in, take one company out. So it's just a great way, and that's what I want to do. And once I start getting nearing retirement age, transferring mutual funds into index funds, that way I can just have that consistent 7% return with inflation. Okay, and before we keep on going down the rabbit hole of different stocks and what they can offer, I really just want to read the definition that the government produces for the SEC produced on their website to show you and kind of help you understand what a mutual fund is. And it says here, and I'll have a link here so I'm not plagiarizing, a mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. The combined holdings of the mutual funds are known as its portfolio. When investors buy shares in mutual funds, each share represents an investor's part ownership in the fund and the income it generates. So the main reason why people buy mutual funds is they're managed. There's people that are literally getting paid to manage these mutual funds to make sure that the investors of this fund get returns back on their money. And it's a great way to make sure that you're not getting hit when the market takes a hit, but you can also see massive gain when the economy sees a gain. It's because it's so diversified, and you can buy into mutual funds that are very diversified, very spread across the board. But also, let's say that you're ready to move from mutual funds into index funds for retirement or vice versa. They're great at being able to be liquidable. So basically what that means is if you're like, okay, I don't want this anymore. I enjoyed it. It got me to where I wanted to be, but now I'm ready to just start investing into more stable, which is index funds. You can sell them off really easily, take that money and just buy an index fund. And so in that way, mutual funds are great because you can just sell your shares, and it's very easy because so many companies that have trading platforms have mutual funds within them. Like Schwab is known for their mutual funds and ETFs. Vanguard is known for pretty much everything. Vanguard's very highly regarded for their index funds that they offer, their mutual funds that they offer, their ETFs. And that's why I really enjoy having a retirement account with Vanguard. But that's also because Schwab offers so much stuff. That's why I love using Schwab. And I have a link down in the description if you want to sign up for Schwab. And Schwab has just as many index funds, just as many mutual funds, and just as many ETFs with usually more diversification and more field-specific diversification. So you can literally buy a mutual fund of just technology. So if you're seeing that, okay, the market is on an uptick and technologies are getting so heavily invested, you can buy into. So for example, I'm bought into a mutual fund that is based in technologies because a bill just passed in Congress that they're going to start heavily investing into microchips, which will not cost a lot. It will help spur these technology-based companies up into an uproar. And so having a mutual fund of a very diversified front of all technology-based mutual funds. And if you want to find a mutual fund based on a certain sector, Google it, just say technology mutual funds. And there will be a list. Yahoo Finance has a really good articles about mutual funds and what they have to offer and what stocks are in them. Motley Fool is also a great resource to use because it tells you, it usually lists out why it's a good investment, what investors are seeing, and what the government is even doing to spur this on. Now, there's also So mutual funds doesn't have to be just stocks. It can also be bonds. So a company can go buy a bunch of bonds, and the returns on the bonds you're also buying in. So it's just a good way to be diversified and have secured increase of your wealth. And another big thing about mutual funds is you can get capital gains distributed back to you. So the money you put in, you can also see come back at you with greater interest and growth. So usually with the mutual fund, not only are you seeing growth in your pocket because of dividends, you're also seeing growth because of the mutual fund is actually just going up. So you're seeing capital gains. So at the same time, one, it's liquidable. So if you're not happy with what's going on, or you just want to prepare yourself for retirement, you can sell off and go into index fund, or you can stick with mutual funds because they also have a very great way of having capital gains, but also having dividends. So you may see some mutual funds have anywhere between 15 to 30% returns each year. And that's why some dividend funds like the Vanguard high interest dividend fund, so that's why dividend mutual funds can also be really good, is because you're seeing a consistent return of anywhere between 7 to 30% just by the stock increasing in price, but you're also seeing 2 to 3% in return in dividends, which is a great way. It helps grow your portfolio in cash. And obviously, if you have dividends coming back into you, you can either have automatic reinvest, so you're buying more and more shares, so your dividends grow bigger and bigger, while your stock is also growing bigger and bigger because of capital gains. But then at the same time, if you don't want to have automatic reinvestments, you have more and more money to put into index funds or any other stock you want to buy. So it's just a great way to see consistent growth to beat inflation, but then also see growth on top of it, and then have dividends on top of it. So think of mutual funds as a multi-tiered cake. You'll see capital gains, you'll see somewhat inflation-based growth as well, and then you'll see dividends or whatever else you're seeing. And because it's professionally managed, you can see a lot more growth and a lot more returns in regards to your growth. But index funds are also a two-tiered cake because you see capital gains on the bottom tier, but then on top of it, you see the top of the cake, which is also inflation. So when inflation hits, you get all of that back. With that being said, mutual funds are a great way just to get into the market, but then also be able to diversify, but then also be able to pick and choose what sectors you want to buy into, because you can buy into, dividends, you can buy into technology, you can buy into oil, you can buy into just any sector you want to, but then also there's many more base mutual funds that are great at being managed. So Vanguard, Schwab, all have really good management of their mutual funds. So if you just go on Google and you figure out what you want to look into and what mutual fund you want to buy, it's a great way just to get into the market. Now, if this doesn't provide any clarity, I'll make sure to put any links down in the description for you to find. Real quick, I do want to say, you may be asking, how do funds make their money? Well, usually most people are buying and holding mutual funds. So when they sell, they get a small percentage of what the capital gains are, or whatever you sell it at. So you may buy it for $100 and then sell it and it's worth $500. They'll take about 1% and take the $50 of the capital gains, and then that way they're getting paid, you're getting paid, everyone's happy. And so that's why mutual funds are a great way to see consistent returns. Now, obviously index funds is purely capital gains, but mutual funds is usually capital gains plus inflation plus dividends or whatever else. I love mutual funds. They're really fun to research, so go out there and research. Now, obviously, if you haven't watched my intro to investing, research and staying up to date. If you're investing in a mutual fund, make sure you're staying up to date as to what the fund holders are doing with the stocks that make up the mutual fund, just so you're completely informed. So stay informed, stay accountable, and make sure that you keep yourself consistent with your investments, because obviously all it takes to make yourself a millionaire by the age of 65 starting at 20 is $6,000 a year into an index fund or mutual fund. So it's crazy. Just get yourself in there and make sure you become a multi-millionaire that is completely tax-free using Roth IRAs by Schwab or Vanguard or whatever. Now, with that being said, I hope you enjoyed today's video. If you did, leave a like, hit that subscribe button, and smash that notification bell so you'll be notified when I make a video and publish it. And with that being said, it is Money Sausage signing out. See y'all.